Hey everyone, so in the last video, I walked through that complete guide to charitable gifting, and at the end I mentioned that there were a couple of related topics worth their own video, and this is one of them. So the question that I want to tackle today is, if you want to give to charity, should you give cash or should you give in kind? If you don't know what giving in kind means, then this video is for you. We'll walk through the comparison of how this works, when it makes sense, and I'll run through some actual numbers with a simple example so you can see the potential tax savings of considering this strategy. So let's say you got a scenario where you want to make a donation. You don't have a lot of cash sitting around, but you do have an investment portfolio. Can you donate these securities in kind instead of writing a check? Short answer, yes. And in a lot of cases, it's actually a better way to give, even if you do have the cash to give. And I'll get into why that is the case in just a second here. But one important caveat in this strategy is really designed for securities held in a non-registered account, meaning a regular taxable investment account, not your TFSA, not your RSP. Here's why those don't really apply to this scenario. So there's no tax inside a TFSA. If you wanted to donate the money, you could just sell the securities in your TFSA, withdraw the cash, and donate it. There's no tax consequences either way, nothing to be gained from an in-kind donation. With your RSP, it's kind of the same thing, but there can actually be a negative implication because you could sell the securities within your RSP and have no tax triggered. But to actually get that money to the charity, you're going to have to withdraw from the RSP, which will result in that amount that you withdrew being added to your tax return and then taxed at your marginal rate. So there's actually going to be some negative consequences of donating from your RSP. So when I talk about in-kind donations here, I'm specifically talking about investments in your non-registered account. That's where the strategy can actually save you some money. Now getting into the definitions and what actually an in-kind donation is. I've hinted at it a couple times here. But simply, you can donate cash or you can donate securities, right? So a cash donation is what we all understand it to be. It's, donating physical cash, a check, doing an e-transfer, wire transfer, any way of basically sending money from your bank account to a charity. An in-kind donation, on the other hand, is when you donate the actual asset itself. This could be a stock, bond, an ETF, mutual fund, whatever. Rather than selling it and sending the cash, you can send the asset directly to the charity. So a simple example would be, as opposed to, selling your 10 shares of Royal Bank and donating the proceeds, you could just donate 10 shares of Royal Bank directly to the charity. The charity gets the same economic value either way, but the tax treatment for you is very different. And that's the whole point of this video and why you should consider this strategy. So the first thing that you'll want to do if you're in this position where you're thinking, hey, maybe I should donate stock instead of donating cash, is to make sure that the charity you want to donate to can actually accept it. So this is not an issue for most larger charities. They will have a process in place and they'll have some stuff on their website. It'll be a pretty simple process. There'll be some forms and stuff to transfer the shares from your brokerage account to theirs. It should be pretty seamless. But sometimes for smaller charities, they aren't set up to receive in-kind donations. They've either never been asked or, they don't have a brokerage account and so they can't accept it. But if your donation is meaningful in size, often that is a big enough push for the charity to get this set up. If you're asking about it, you're likely not the only person that's ever asked about it. So it's not super complicated for the charity and it's in their best interest. They'll just need to, go through some paperwork and get a brokerage account open in the charity's name. But it's worth a call up front just before you decide, hey, I'm going to do this. Make sure that the charity you're donating to can actually accept those funds. Now the part that everybody is mostly interested in is, how does doing this actually save me some tax? So it comes down fundamentally just to capital gains and how that gets recorded on your tax return if you sell an asset and donate cash versus donating an asset directly. So a quick refresher on capital gains. When you sell an investment for more than you paid for it, the difference between the price you paid and the price you sold it for is a capital gain. In Canada, 50% of that capital gain is taxable. So if you have a $10,000 gain, $5,000, 50% of that gain, gets added to your income on your tax return and taxed at your marginal tax rate. So this is what makes the whole strategy work. When you donate securities directly to a registered charity, the government eliminates that capital gains tax. So instead of reporting 50% of your capital gain onto your tax return, you're not reporting anything. So this gain is essentially wiped out for tax purposes. You'll still, though, receive the full donation credit for the market value of the securities you donated, but again, you're not going to have to report any capital gains. That's the whole game here, and that's why it can be very beneficial to do this. So I'll walk through a simple example with some numbers, but first some background info to sort of set the stage here. So let's say you want to donate $10,000 to your favorite charity. These securities have a capital gain of $10,000. Miraculously, you have zero cost base. Again, this is just a simple example. You're very likely going to have some cost base on your investment. But just to keep it simple, you've got $10,000 worth of a stock and you have a $10,000 capital gain. You're in Ontario and you have a 30% marginal tax bracket. So that means that any additional income that you add onto your tax return is going to be taxed at 30%. For sizable donations, you're basically going to get 40 cents on the dollar back as a tax credit. Those are the main items to consider when setting out an example like this. So, scenario one is to sell the securities and donate the cash. So in this case, we've got a $10,000 donation to charity, but you're going to sell your $10,000 worth of investments first, which has a $10,000 capital gain. So you sell your investments, you trigger that $10,000 gain, 50% of that has to go onto your tax return, so $5,000. Since you're paying tax at a 30% marginal rate, that means that the sale of this investment is going to cost you $1,500 in tax, which is 30% times your $5,000 capital gain. Then you also get your donation tax credit of about $4,000 for this donation. So again, that donation, the tax credit is not a tax deduction, it is a credit, so it can be used to help pay the tax you owe. But if we look at this just line by line, you donated $10,000, so you're $10,000 out of pocket. You're an additional $1,500 out of pocket because of the tax you had to pay on the sale. But then you get $4,000 back on your tax return. So the net cost of making this $10,000 donation is about $7,500. And that's great because it means that you're able to, the charity still gets the full benefit of that $10,000, but it only cost you $7,500. So it seems pretty good. But if we do the same thing and instead of selling the investment, you just donate the shares directly, what happens is you eliminate that capital gains tax layer that was in the previous example. So again, if you just donate the securities directly worth $10,000, you're out of pocket $10,000 because your stock portfolio is now down $10,000 from the donation, but there's no capital gains tax here. There's no additional cost as a result of making this donation. But you still get your $4,000 tax credit that you can use on your tax return. So as opposed to the net cost of your donation being $7,500 in the previous example, in this case, it's $6,000. So it costs you, 60 cents on the dollar to make a donation, which is great. Again, the charity gets the full benefit of this donation that you've made, but it'd only cost you $6,000 because you're receiving $4,000 of a tax benefit. So that's the magic of this strategy and why it can make sense, especially for people with non-registered portfolios that are making charitable donations, to consider giving using an in-kind donation versus a cash donation. Most people are on board with that. They understand, I'm going to make the donation anyway. I may as well keep more money in my pocket. Most people are on the same page with that. But a couple of follow-up questions that I get frequently is, one, what if I want to keep owning those shares? Well, there's basically a couple options of what you can do. But if you want to keep owning those shares, you could donate the shares and then use the cash that you were going to use to make the donation and just buy the shares back. There's some really good benefit in that, in the sense that you skip the capital gains tax that would have occurred if you had sold those shares and donated, and your new cost base on those shares is now higher, meaning that if you sell those shares down the road, or if you pass away with them and they're sold as a result of your death, that the cost base is now higher, meaning that you're going to pay less tax in the future. So this strategy, even if you want to keep holding the shares, helps reduce your current tax bill and your future tax bill. So it's a win-win. The only thing that you should consider is if you want to keep owning the stock, but you don't have cash to buy that stock back with, you may have to sell some of your other investments to then buy this investment back. And selling of all those other investments can create their own capital gain, which then will increase your income. So there could be some tax implications of doing that. So you just want to make sure that if you want to really own the stock, that you have a plan for how you're going to purchase that stock back. The other item is you don't want to donate shares that are at a market value less than your cost base. And this is basically the exact same reason you do want to donate in kind for appreciated shares. It works in reverse, because if you have a loss on an investment, you want to sell that investment, crystallize the capital loss so that you can claim it on your tax return, and then donate the funds to charity. Again, this just is the strategy we discussed working in reverse. So you don't want to do this strategy on shares that have declined in value relative to your purchase price. So to wrap up, if you've got shares with appreciated value in your non-registered account, donating them in kind is almost always better than selling and donating the cash. You'll get a full donation credit and the capital gains tax is eliminated. If you want to keep the position that you're donating, buy them back with cash you would have donated, provided that you have that on hand. And if you don't, consider the other investments that you would need to sell and the tax consequences of doing that before you make your decision. It's worth repeating, don't donate shares that have depreciated in value. Sell those first, trigger the capital loss, and donate the cash instead. If this kind of planning is something that you want to think about for your own situation, talk to your accountant, your financial advisor. The dollars saved if you're a charitable person can be meaningful and add up quickly over time. Thanks for watching.